Welcome back, and joining me for a closer look at what's played out on the market scene today is Towell from Sasfin. Well, thank you so much for your time, Rob. Let's start off with the macroeconomic data. With the quarterly employment statistics print, or rather non-farm payrolls, we did see an uptick 0.1%. I don't even know if we should call that growth, and that is quarter on quarter, but then still things looking quite grim on a yearly basis with a decrease there. I guess this is really no surprise considering the kind of economic growth that we're seeing, right?
Yes, I mean, at least it did go up for the quarter, and anything positive is better than going negative and getting worse. So it has been getting a little bit better quarter on quarter the last 2 quarters, but we need to produce much more jobs than we produce, and everybody knows it. And really what we need to do is to get the private sector running properly, and hopefully partnerships between private sector and government. That's where you're going to get employment from. And those initiatives really have to start kicking off now so we can start to improve the employment data.
Right. Well, let's drill into the JSE. Of course, still earnings season here back at home. Remgro coming out with interim results. It was actually one of the biggest gainers on the JSE today. Last time I checked, it was up more than 4%. Solid growth in headline earnings per share there of almost 39%. Intrinsic net asset value per share ticking up double digits as well. Interim dividend also getting a bump of 20%. Has Remgro turned a corner, considering that it came out of a year where it was negatively impacted by its corporate actions that it had taken?
Well, it's done a lot of corporate actions in the last few years. It's unbundled right from the beginning, from First Rand. Mediclinic's been in there. They've done a lot of manipulating and changing of their portfolio. And you're starting to see fruition and benefits from all the different changes that they've made. So up 39% on headline earnings. Also, the intrinsic value, which is 276, is now 70% above where it's currently trading. Now, on a holding company, you quite easily will get a 30% difference, but now it's at 70%. I think people are going to start looking at that and seeing, there is definitely a gap to close there. They're managing it well. They're doing quite a lot of deals, and they're still doing deals. And then the assets that they've kept are really strong. Outsurance doing really well, which they still own. Much better operations from Mediclinic, and all their operations are, still really running well. Even Heineken has turned the corner, starting to show a little bit of profit there as well. And we see the brewers in general coming back if we look at ABM Bev's numbers as well. So the business is looking really good. They've still got another deal with Vodacom on the cards. Yes. So I think the business is looking relatively attractive at these levels, and I think you could definitely add it to a portfolio.
All right. Well, talking about businesses being attractive, there is a business that is attractive to a consortium, Barloworld. But of course, we're not talking about that deal today, but the 5-month trading update that they put out, seeing a softening in the financial metrics. So what's interesting is that revenue decreased with or without the pressure from the Russian business that has been quite a thorn in the company's heel for a long time. What is characterizing the company's performance?
Well, I think the EBITDA was down 12%, so that is relatively weak. We expected some profits from Russia, but that was at zero. So we saw no impact from Russia in the numbers, and I think that's going to make it difficult for them to get to the numbers where consensus expects them to be in the next 6 months. So they're quite below consensus at this stage, and it's showing you that they really are battling with their businesses. Mongolia is the only business where they're really showing really good growth. South Africa under a little bit of pressure, and the other businesses, flat to a little bit up. So they're under a little bit of pressure, and that price now at 120 Rand looks very interesting again. They said it was too low and people voted against it. But with a set of numbers like this, the share could easily, retrace further down. If it wasn't for the bid at the moment, that standby offer, you would have definitely seen Barloworld under 100 Rand. So, that deal at 120 is looking quite interesting at the moment. And maybe people are going to look at that again and say, maybe we should take the offer. They're just not getting enough traction, and there's just not enough growth in their sector of the industries. Possibly, if they sort Russia out, and I think maybe that's what the long-term shareholders are looking at, that if Russia comes right and they don't have a big fine to pay to the Department of Justice in America, then it will look interesting again. So it's a difficult one. I'll buy it maybe for the corporate action, but I wouldn't buy it otherwise.
All right. Well, talking about buying, Pepkor is buying some businesses from Edgar's owner, Retailability. We were actually having quite a debate in the newsroom about whether these new businesses fit into Pepkor's strategy. And I'm wondering if Pepkor is undergoing a transformation in its business model.
Well, you got good retail sales in that came out in January, so you start to see the consumer spending a bit. But I also think that you need scale. So, to get growth in South Africa with consumer under pressure in general, and people battling to buy new products across the board, you need extra scale and you need more stores around to get that volume. So, they're buying this asset that's 460 new stores across all environments, South Africa as well as some outside of South Africa. So, they're buying a little bit of growth there. I think they are quite good brands. Boardman's has been a long-term brand, hasn't really got traction under Edgar's, and possibly they can grow that brand. And then on the clothing side, the more they can produce and the more they can do group buying and buy for a larger group, the better they can get their margins up. So I think it's a good deal for them.
Okay.
But I think they are looking to grow, to buy growth rather than create some of their own growth. They have gone overseas as well, and they're in Brazil. Brazil, looking like a really good purchase there, but they're also under a little bit of pressure. So that hasn't come to fruition just yet. But I think that, this is a good asset to buy for them. And it just keeps keep giving them extra strength and build a really large business on the clothing side in South Africa.
All right. Well, let's quickly get to your stock pick for today. Rob, what are you choosing?
Well, as I said before, I really like South African banks. I still think they're underappreciated in this environment. My pick today is FirstRand. They are under a little bit of the cosh because they've got a possible fine coming to them in the UK, and I think that's keeping the share at bay. That fine or that court case is going through in April. If they get a positive outcome there, it's looking really cheap. But I think irrespective of that, they have made a provision. And at these levels, I think you can definitely buy FirstRand.
All right. Well, thank you so much for your time and for your analysis on what has moved our money today. Rob, that was Robert Towell from Sasfin Wealth.